Hey everybody, good to be here today. My name is Brent Moore. It's time for Advanced Option Strategies. Last week we talked about calendar spreads. This week, I want to narrow down the focus a little bit. We're going to talk about a specific application of calendar spreads, and that is calendar spreads over earnings. Earnings season is upon us. We're in the middle of it. Well, we're in the early end of it, I guess we'd say, but we are in it at this point. And so how can calendar spreads be used for that? We're going to cover that next. And glad you're here. Whether you're watching on a recording, whether you're watching live, I don't care. Just glad you're here. I am joined by my friend and my colleague, Mr. James Boyd. And make sure as you are watching our webcast, we have a variety of webcasts that you can follow, different topics. This is Advanced Option Strategy. We try and take a little bit more of an intermediate to advanced look at options. If you are brand new to options, I encourage you to stick around, but realize we do have a Getting Started with Options webcast that you can check out. Also, James teaches an Investing Master Series, I think is the new name of it, Investing Master Series. Yeah, check that out. That's on Tuesdays at 11 o'clock Eastern Time. And you can follow James or myself on X, formerly known as Twitter, at BrentMooreCS, at James Boyd CS. Options do carry a high level of risk and are not suitable for all investors. And the information here today is for general informational purposes only. It's not an individual recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Paper money software application, which is what we will be using today, the thinkorswim desktop software, is for educational purposes only. All investing involves risk, including risk of loss. And short options can be assigned at any time up to expiration, regardless of the in-the-money amount. Past performance of any security or strategy does not guarantee future results or success. Excuse me. All righty, folks. Let's take a look at that thinkorswim platform here. Pull that up. That's the SPX. We're up a little bit today, and we've had quite a run. I have a 20 and 50-day moving average on there, and you can see we've been running up. Now, obviously there's a lot of different things that can affect the market. One thing is earnings, and obviously that affects individual stocks. Individual stocks can move quite significantly on earnings. In fact, we just had earnings on Netflix, and look, this is kind of what you see. You see gaps like that when you have earnings very often. And that affects not just the stock price, but it can certainly affect other things associated with that, such as implied volatility. Now, for those of you who weren't with us last week or aren't familiar with calendar spreads are a vega positive trade. Vega positive. So what that means is they tend to benefit if implied volatilities go up. So you may be asking yourself, Brent, why would you ever do a calendar spread on earnings? Because we all know what happens on earnings. Implied volatilities typically do something very different than go up. For example, let's take a look at, I'm just going to look at Microsoft here as an example. Now, there's some stocks that are very obvious here in what they do and on earnings. Let me switch this to, let's go to a 1-year chart here. And here's what I want you to see. And we're looking at Microsoft, and we'll look at a couple others too. Look at earnings. So these are earnings when you see that little red and blue dot there. And look at, this is a chart of the implied volatility on those. Look what happens on earnings. Look what happens to implied volatility when earnings comes out. Okay, look there. Look there. Look there. Now, we haven't had earnings yet on Microsoft, but, it probably doesn't take much to envision what could possibly happen on implied volatilities, okay, with earnings. Let's look at maybe one or two more, okay? That was Microsoft. Let's look at Meta, okay? Facebook, aka Facebook. Here's our earnings right there. Implied volatility. Here's our earnings, implied volatility, and sometimes more, sometimes less. Let me do one more just to kind of get the point across here. Here's Amazon on earnings. And now these companies I just picked out on this one, big drop. There you go. Huge drops. And again, we don't have earnings, but I think the, expectation is implied volatilities. Now, this is average implied volatility. So this is implied volatilities of different months. And that's going to be an important point as we talk about calendar spreads, because with calendar spreads, we're going to try to benefit from the differential in volatility changes among different expiration dates. All right. Now, not every stock drops as much. If you go to more, more stable company, I don't know, stable's maybe not the right word, but some companies just don't drop as much. Coke, little drop there, little drop there. Even some stocks like Tesla, we got Tesla coming up with earnings just in a few days. But we actually have seen quite a drop on implied volatilities before that. What Tesla does is like they pre-announce deliveries. And so that takes some of the uncertainty about earnings out of that. But, so if earnings are coming up, there's different strategies you can take. One strategy that people will do on earnings is they'll do something like, say, a long straddle, okay? They'll buy a call. We've talked about this in this class. They'll buy a call and they'll buy a put. And the theory is if it moves one way or the other, it's supposed to be a U, one way or the other, enough, you can make decent money on that. And people look and they go, well, look, stocks usually move a lot on earnings. Therefore, it seems like a logical time to buy a straddle, okay, or a strangle, doesn't matter. And the answer is, yeah, maybe, but the downside, the thing that makes it difficult is if you're buying these when the implied volatility is high, and then that implied volatility drops, then we get really hurt by those. By hurt by that, it makes it a much more difficult strategy to do there. So when we talk about calendar spreads, remember, we are selling an option. Okay, we're going to sell, I'm just going to say call here. You can do put as well. We're going to sell a call and we're going to buy a call. Is this positive vega or negative vega? Well, overall, we say it's positive vega, but the sold call, the short call, is actually negative vega. The long call is positive vega. So if the implied volatility drops, do these just cancel each other out? Not necessarily. Not if they're the same, because implied volatilities are different between the months. Let's take an example of that. Let's look here. Let me get out of that. Let's just look at an option here. And here's Tesla. We were on Tesla. Notice Tesla is not a great example because there's not a huge difference here, but we got a 66% implied volatility for this month. This is the average implied volatility for this month, for this expiration, okay? And notice it's different as you go forward in time. Well, let's look at some others. Here's the calendar for earnings. So I just have earnings displayed, and this isn't every option, but these are more liquid options. Every stock, but these are more liquid stocks. And today, I don't even know what today. Today's the 18th. Okay, so here you can see, here's some companies that are coming up with earnings. And if you look at these, like here's Boeing, here's AT&T. Well, let's look. Here's Boeing. Look what happens to implied volatilities. They drop. The ones near before expiration are higher than the ones after expiration. But once, not expiration, but earnings. The ones before earnings are going to be higher than the ones after, excuse me, the ones, I take it back. The ones right after earnings, immediately after earnings, are going to be your highest typically, okay? And then immediately after, they tend to drop. So let me give you an example here. Let's look at Google, okay, or Alphabet. we have earnings coming up. Let's see when earnings is. Earnings is on the 29th. Okay, I'm just on earnings under analyze. So, 29th of October. So we're going to take the first expiration after earnings. That's November. Notice our implied volatility, about 42%. Then it drops down to 39, 36, 34, 32. Do you see the decline in implied volatilities there? So if we sell a contract that has a higher implied volatility, that's a negative Vega contract. If we buy a contract that is a positive Vega contract, so we're buying that, but this drops more than this, then that should benefit us in theory on that. Okay? All right. So we'll do an example on that here in just a minute. But that's what I want to show you. So how much is this going to drop? Well, I don't know exactly, but typically after earnings, it's going to drop to be pretty similar to these. Okay? So my 42 implied volatility is, I don't know exactly where it's going to go, but it's probably not going to be that different than this implied volatility. So we're looking at about a 10-point drop in our implied volatility on that. All right? So that's the theory behind it. I want to talk about practice, but that's the theory behind it. Let me just address questions here. How we would use Vega? Well, the principle of Vega is, I'm going to show you this, so stick with me just a little bit. But the difference in implied volatility, basically what I'm using Vega for in this is Vega is going to tell you if implied volatility changes are going to benefit the trade or be a detriment to the trade. In this case, we're splitting the calendars apart into the short component and the long component. And we're saying it's going to affect the short component. The drop is going to affect the short component more than it hurts the long component. Now, that is just one aspect of the trade. If we do a calendar spread at a particular strike price, say $160 strike price, and the stock goes up to $180, it's probably, even though we're benefiting from the Vega aspect of it, we may very well still lose money, right? This is not a guarantee. We're just trying to get the benefit that we can from this. Okay, so that's that. There is a survey link in the chat. So another question. So I suppose that once the calendar hits and passes the earnings date, then also the beta will be, well, so volatilities will typically be, you'll have a more volatile event. Okay, I wouldn't say it's exactly beta, but we'll have a more volatile event coming up with earnings. And then once earnings passes, a lot of times you'll see reduced volatility after that. Okay, so let's do this. Here's what I want to do. We'll look at Google or Alphabet, excuse me, to start. So here's what the premise, and I'm going to go to the Analyze tab on this. I'm going to go to Add Simulated Trades. I'm going to look at the stock, and for the stock, first thing we're going to do is we want liquid options. Well, start with the liquid stock. Alphabet's typically pretty liquid, right? And then I wanted some sense of kind of like a technical forecast on this. If I think the stock is going to go crazy high or crazy low on this, probably not. We're probably not going to do a calendar spread. If I'm a little bit more bullish, I'll likely do a calendar spread with strikes above where the current stock price is. Current stock price is at 163. If I think it's going to go down on earnings significantly, I'll pick a lower strike. In this case, I'll pick something, I'm going to say, in general, we've been more bullish. In general, this is kind of what we've seen here on this stock. Had a little break of it there, but for the most part, so I'm going to look for something a little bit above where we're at. I'll look at like a 165 strike. But let's see how this works. So I'm going to look at the 165 strike, and I'm going to go out to the past earnings. Okay, we can tell, even if you don't know the date, you can tell. Look what happens to implied volatilities between this, like they double the implied vol. That tells me there's uncertainty on this. This one's going to move more. Why is this one low? This one is it's not going to be affected by earnings because this expiration date will be done and gone by the time earnings occurs. So our implied volatilities are going to be lower. But so here's what I'm going to do. I'm going to sell this November 1st. I'm going to go to calls here. We'll do a put example probably too, but let me do a call. I'm going to sell this by clicking on the bid price. And then I'm going to go out a little ways. And I'll go to 9th of November. I'm going to pick the same strike because it's calendar spread. And I'm going to buy that one. I just clicked on it. And let me just move this up a little bit here so you can see it. There's our trade. Let's look at our risk profile on this. Now, here's what I want you to notice. Number one, where is our max gain? Well, our max gain is right there, right at 165, where our strikes are. Okay, that's just calendars 101 right there. We can also look and see, well, where's our break-even points? What's our percentage on this? So today's the 18th. I'm going to go to November, what did we say? November 1st is our expiration date on that. So I'll go November 2nd here. And I'm going to set my slices to break even. Here's my break even slices. So roughly just on the surface, this is just a probability analysis. It's not a guarantee. Okay. 63%. Yeah. 63% probability, break even or better. That is in between our strikes there. But look what happens here. If we look at our implied volatilities and we say, how much were we looking to drop on that implied volatility there? We were saying the difference between our November contract, or November 1st contract, and our November 29th contract, 42 to 32. That's roughly a 10 percentage point drop, okay? And so I'm going to adjust my volatility on this, but I'm not going to adjust them both. I'm going to drop this one down about 10%. Now, the reality is this one may drop more than 10%, but this one may drop a little bit too. But there's the differential there is what I care about here on this. So when I do that, now look here. Look at this line. Actually, I'm going to go back here one sec, because I didn't point it out ahead of time. Here's this purple line represents our profit loss given today. Okay, this is our profit loss given today. I'm just going to leave that line right there for a sec. Okay. Now, what I'm going to do is this: I'm going to now adjust this. I'm going to say about 10 points. Okay. Now let me put that line back on if it'll let me. There we go. Do you see the difference in the line? I'll do like a little dash here. Now, is that everything? No. Like I said, if the stock goes out here, this trade is probably not going to work out very well. Okay. If the trade goes down here, the trade's probably not going to work out very well. But in between these areas, it makes a big difference. Let's think of it another way. Let's look at our profit loss open on this. Let me go and add a slice to this. Here's our break even. Our PL open, given that percentage drop, is about $115. That is not assuming any change in stock price. That is just solely from the implied volatility. So basically what this calculation is telling me is if the implied volatilities of these basically equal each other, then that's going to be the effect of Vega on the trade. Fair enough? So now, is this one going to stay put? No, it's probably not, but this one's probably not going to stay. This isn't going to be exactly, we don't know. This is kind of speculation. The point is this: we don't know exactly, but they should come close to being much more equal than they are. So here's another thing. If I look at this, and let me just zero that implied volatility out again. Right now, our max gain on this trade is, it's a little hard to read, $379 is our max gain. Now that would be if it's perfect right there. If it's perfect right there, 379. But let's do that implied volatility thing again. So we're going to go minus 10, change our implied volatility. Now our profit loss is 115. That is, of that 379, almost a third of it, at least a quarter of it, is attributable just to that implied volatility there. Okay. So there you go. Now, if you want to play with this, you can play with this. You can adjust this and you can take a more conservative measure and say they only get 5% closer to one another. Can you do that? Yeah, you can do that. You can adjust both of them. You can look back in time and see what those are. But that's what the trade would look like. Now, what if we enter this trade? When do we get out? Well, typically, traditionally, earnings trades, and this is true whether you're doing a straddle type earnings trade or a calendar type earnings trade, we're going to get out soon after earnings. Now, you may give it a day or two, but soon after earnings, we'd look to get out. So that's what we're going to look at. So if I want to do that trade, what I can do is I can go to the trade tab. I can go and I can click on calendar if I want. I usually find it just as easy just to go here, pick my strike, click on it. I'm selling that one. Go down here, pick my strike. It's on the ask price. If I'm going to buy it, hold down the control key. There's a calendar spread for me. Remember, calendar spreads are debit spreads. They're debit spreads. So I can confirm and send, and then I could send that, send this in there, okay? All right, let's see what we got here. Make sure you read the note. Remember, short options can be assigned early. We have a short option that's going to, it's more likely to be assigned if it goes in the money. But there you go. I'm going to throw that in our option trades bucket there. We're going to send that. In general, what I would say is this, is if you're looking for calendar spreads specifically over earnings, it's more beneficial if you see a bigger difference in our implied volatilities, these are our average implied volatilities here, than if you don't have much difference there. So you can go through your calendar and you can look and you can see which ones have bigger. Let's KHC and take a look here. And then we'll look at like more that's probably more volatile, INTC. So let's look at KHC. So here's KHC, and look, there's a difference. Actually, it's not too bad. I don't know what date earnings is, but I can tell you it's going to be right before, it's going to be between these two expirations, between my 25th of October expiration and my November 1st expiration. Why? Because that implied volatility is higher. So that 29% is likely to go down a fair amount. These may move a little bit there. So there we go on that. So let me just double check. I want to do another trade. Let's look at Intel here. Okay, here's Intel, and you can see our implied volatilities on Intel. Now you may be looking here and going, why is this 100%? You know what? When we get right near expiration, these contracts are expiring in about an hour and a half. You tend to get really elevated implied volatility levels there. So discount that, okay? So there we go. So let's do a trade on this, but let's find, where's our earnings going to be? Our earnings is going to be right before the bump up in implied volatility. So I'm going to stick with this November 1st here. We're going to look to sell that, but let's look at the chart. Bullish or bearish bias on this? Well, I don't know. Things can certainly change on earnings. Intel's been beaten up bad over the past couple of years. At some point, they may make a legitimate reversal. They've tried, like when we look at Intel, it kind of, you may think, oh, well, it's going flat, maybe that'll reverse. It's going flat, maybe it'll reverse. It dips down. It's going up, maybe even going up a little bit, maybe it'll reverse. I don't know what's going to happen, but I'm going to say this. I'm going to say this is more bearish, okay? More of a move down. And so I may go down a little bit, but mostly I'm going to stick close to where we're at. We'll have to see what strikes are available. Right, we're right around 22.5 right now. Let's see what we got. So let's go to the trade. If I go here, I do have a 22.5. If I want to slant this a little bit more bearish, I can do the 22. Okay, I can do the 20. We'll just go at the money here right now on this. 22. I'm going to do the put. It's barely out of the money. 22.50. I'm going to sell this one. Now, before I do that, though, let's take a look. 79% implied volatility. If I go out, we'll say towards the end of the month, we'll go out about here, we're down to about 62%. So that's what, 16, roughly a 16% drop in implied volatility. Even if we don't expect the entire drop, the entire difference, the entire gap between those to be completely evaporated, well, I think it's certainly reasonable to expect it's mostly going to go away. So what if we expect like a 12% drop in implied volatility? Let's see. That'll be a little bit more of a conservative measure. Let's do that trade. So here's what I'm going to do. We said the 22.50. I'm going to sell that. I'm going to go down to the, we'll go towards the end of the month. We'll go to the 29th. Now remember, when we're picking this early expiration, usually I'm going to pick the first one after earnings, because that's going to be the one that has the highest IV. Okay? Now, Sim said in the chat, hey, Intel tends to move more on earnings. That's why the IV difference. Yes, you're absolutely right. Folks, there are no free lunches out there. Okay. When we see high implied volatilities and we're going, ooh, even if we're just looking at a simple short contract, let's say we're looking at a short put or something like that, or we're looking at a covered call, and we see, ooh, implied volatilities are high. Isn't that great? It means more premium. Well, yes, it does, but it's not free. The reason people are willing to pay you more for the option, why implied volatilities are higher, is there's more uncertainty about the movement of that. People expect bigger movements of those. All right? So there we go. Okay. So George said, diagonal say, no, we're doing calendars, but we did calendars last week. We're doing calendars, a specific instance of calendars, taking advantage of earnings, about the implied volatility crush on earnings is what we're looking at there, okay? So that's what we got. There is potential movement here. So again, if I think Intel's going to be moving a lot, more than what the market expects, then I want to do this. I'm going to go to that 22.50. You do need to be a little careful, because I suspect if I don't go to the weekly, we may not have that 22.50. If I go here and say, oh, this looks good, yeah, there's no 22.50 on that. Okay, so you got to be, those weekly contracts often have more strike prices. I'm going to control click and buy that buy that. So there we go. There's our trade. Let me right click. I'm going to analyze this trade. Here's our trade. Let's set slices to break even. And yeah, those look right. So let's set slices to break even. Set slices, break even. 11.2 is where I want to go on that. So again, on this one, about a 62% chance, according to the probability stats here. They're not perfect, folks. There's not, you could read this and say 62.12%. Don't attribute that much precision to what this number goes. So what this number says. But it gives you a kind of an idea of kind of the odds that we're looking at, even though they're not guarantees. All right. So here's our break even. About 25.70. Let's look at that on a chart. 25.70 is roughly, this isn't going to be perfect. It's going to be roughly there. Okay. Is the stock going to stay in that range? Well, maybe it is, maybe it isn't. With the implied volatility, it may help us out a little bit there on that, though. Okay. So let's go to analyze. If I add a slice in, break even, so right now, PL, just because of slippage, probably down a $1.50 there. But let's put in that difference. We said 12, we were going to take a more conservative approach on this one and say we were looking at a 12% drop instead of the full, I forgot what we said, 18 or something like that. I'm going to put in minus 12 on the implied volatility. So instead of that down $1.50, our PL day is showing up about 1950. And now you may be going, well, 1950 isn't that much, but keep in mind this is only a $46 price tag on this contract. Okay, this is not an expensive contract. Our strike prices are lower. Our max gain is right about 100, almost right on the nose there. So that represents about a fifth of what we're going to do. So remember, when we're talking about options, price, time, and volatility are kind of the biggies there. Here we're focusing on volatility, but if that can give us a 20% move, 20% of the overall price, that's substantial, right? That's nothing to sneeze at. And so that is why, by the way, when we talk about calendar spreads and we say calendar spreads are positive Vega trades, you could still do them in front of earnings because of the differential in our implied volatility drop there on that trade. So let's go and let's throw that trade in. Then I want to talk about some management here on this. I'm going to confirm and send. Remember, these can be assigned early. And there we go. Okay. All right. So let me just see if we have questions, and then I want to talk about management of some existing trades. We put on a calendar last week. Let's talk about management of that and some others here as well. See if I missed anything. Let's see. Is there a way to isolate the IV in the sense of having a strategy that's not, this is from Sim, I appreciate that. Is there a way to isolate the IV in the sense of having a strategy that's not price sensitive, which also pays off more than the risk-free rate? Okay. That's a good question. This is price. This strategy here that I'm talking about, and this probably is the reason for the question Sim's asking, is Sim is looking for a strategy where we could just take advantage of that implied volatility, but there's the price, but it's not subject to that price risk. Right? Well, this isn't it. And I can't think of one there, but that would be nice. That would be very nice to get that implied volatility. There's some that can be less price sensitive, right? You can cap some of these out. That's why we do spread trades, folks. Remember, when you're doing a spread, like if I just look at the trade we just did, let me get a delta in there. Let me get a delta column. Okay, delta. So if I'm going to sell this 2250, my delta here is minus 46. Okay, I'm selling that though, so actually that is a plus 46 delta. And this contract right here is, this is showing a plus, this would be a negative because it's long. This will be a negative 45 delta. So it's really, the difference in our deltas right now is minimal, okay? So right now, it's not going to change much, but the delta can change over time. That's where the gamma comes in. The gamma is going to tell us how much those deltas change depending upon a dollar move in the underlying stock. So a dollar move on Intel is pretty significant because it's only a $22 stock, but we're getting a bigger move in our gammas, in our deltas. You can see that by the higher gamma on the near-term contract versus the longer-term contract. Okay? So delta is one way to look, but that doesn't tell us about total risk and if things move enough either. And deltas can change over time too. It's not just gamma. As we get closer to expiration, the deltas, if you're in the money, are going to go closer to 1 or absolute value of 1. And if they're out of the money, those deltas are going to get closer to 0 as we get closer to expiration. Okay, so there's that Intel. Let me go back to my trade here on this. And did I send that? I sent that. Okay, we're in. Okay, so here's our options here. Now, last week we did a trade. And in terms of calendar spreads, we did a calendar spread on Nike last week. So this was not based on earnings. In fact, we deliberately avoided earnings on Nike. And where are we sitting right now? PL Open, $3.50. Okay. Now, that I laugh because it's kind of typical, to be honest, of calendar spreads. They're not big movers typically. Getting a little bit to Sim's point. Now, there is price risk on these, right? If these move, and especially if we're doing them before earnings, we may get bigger moves in prices. But the calendars have a reputation for moving very slowly, and this is kind of typical of that. So we did an $85 calendar, and we still have 21 days till a short contract expires. So we have time on this. So there's no hurry on this guy. What we want the stock to hopefully stay kind of neutral, maybe drifting up more towards 85, because right now it's about 83. Ideally, we gave this a little bit of a bullish bias, in other words, on there. Okay, so it's not moving much, is it? There. Okay, James in the chat said delta of only 4. Do you see that? Look at the difference between those there. Okay, that's why it's not moving much. So price is not going to help it out that much. Now, we have our delta. We also have our theta. So is theta huge? No, theta is $1.25 a day or something like that. So time decay is helping us out a little bit on that as well. But when we look at this trade, we want stock to go up. No, that's wrong stock. We want Nike. Okay, here's Nike. Ideally, we want the stock to go up to 85, kind of right in this range. Well, hey, in my mind, that's kind of what it's been doing. If I were to draw a trend line here, my trend would look kind of like this. Now the trend can be broken, but if we're talking about managing this and whether we should stay in or get out, first of all, we're not losing, we're making a little bit, not much, maybe pays a commission or something. But the point is, we have plenty of time, and the technicals are doing they're not doing anything against us at this point. Yes, I wish this went up to 85 real quick, quickly, but it's not breaking down on us. That's what we want. And therefore, we're not going to get out of this Nike. We're going to stick with this Nike trade and let that Nike trade work. We just got any intel on a calendar based on earnings, so we're going to sit on that. Alphabet, we got in based on earnings. We're going to wait for earnings. We can see we have a lot of earnings here. Now, we do have a trade that has gone against us, okay? This one's not looking so hot, is it? CVX. And we let this go all the way to expiration. That's expiring in an hour. Or a little over an hour. It's in the money. I'm just going to cut my losses on this here. And so, sometimes you win some, sometimes you lose some. We've lost $133 on it, but that's why we do spread trades. $150 is to try and minimize those losses. So I'm going to close that one out if possible here. We'll send that. Okay. And then let me go back and let's just see, is there I'm running out of time. Let's do another one, Oracle. Here's Oracle. So Oracle, we have 7 days to go. So whenever I'm within 10 days, less than 10 days, whether we're about a week till expiration, so these expire in a week, my inclination is just to look at these and consider closing out in the first place, okay? And so this is, let's see what we got here. We're doing okay. We're making a little money. Look at the current price on this. The short contract, about 8 cents. The long contract, about 5 cents. 3 cents. We can close this out for about 3 cents or $3 here. That's very little to get out of this trade with the week to go, when things can still go against us here on this. So I'm going to look to get out of this trade here. So if I go to Oracle, I have a conditional order on this. I'm just going to, first of all, here's what I can do. I'm just going to cancel that conditional order on Oracle, okay? Let me click on this. I'm going to right click. I'm just going to cancel that order. Okay, that conditional order was just to get us out if things went against us. It didn't. Things went okay. And we have those orders in there to prevent what happened with our Chevron trade, right? That's why we put them in there. In fact, Michelle said, that's why we trade manage. Yeah, absolutely. We didn't have that in there. We should have had that in there on Oracle probably. But in this case, I'm going to take our profits on that. I'm going to create a closing order and see if we can get out of that. Confirm and send, and then send that order. And we're out of Oracle. And that'll help offset some of the loss, at least on Chevron. Not all of it, but there we go. Okay, so let's summarize what we got here today. We talked about doing calendar spreads on earnings. Typically with calendar spreads, they're kind of slower moving trades. We're trying to take advantage of the time decay on those. And we want them to end up kind of near where our strike price is, right? That's a calendar spread. Today we talked about calendar spread on earnings in particular. And in that case, yeah, we still want the stock to end up where the strike price is, but there's more uncertainty around earnings. One thing we can use to our advantage is that volatility crush, the drop in implied volatility on the front month or front expiration in comparison to the later expiration there, to try and help us take advantage of that. So we did a couple of trades in regards to that. That will keep those in, barring some unforeseen circumstance, until earnings date or soon thereafter. And there we go. Hey, there is a survey link in the chat. We do appreciate your feedback on your survey. Thank you very much, James, for helping me out in the chat. Also, make sure you subscribe. We have the Trader Talks channel. When you go to YouTube, You can go up here. You can just click on your screen. There's probably a subscribe button, but go to Trader Talks webcasts. And if you're on the Trader Talks channel, there's playlists. You can look at a whole variety of different classes there for you. Okay, so check those out. Thanks for joining me today. Everybody have a nice weekend, and we will see you. Coming up next, we have ThinkScript studies. Check those out. Check out that class. Mike Fairborn teaches that class. Bye-bye, everybody.